Good afternoon, everyone. I am CA Megha Saxena, Secretary to Auditing and Assurance Standards Board of ICI. Today, on behalf of Board, I welcome you all to this webinar on the essay on the topic of SA 230 and 250, the audit documentation and the consideration of laws and regulation while conducting the audit of financial statement. So both these standards have the significance, as we say that in case if it is not documented, it's considered not to be done. So I think everyone understand that significance of the documentation, and we have the requirement of 7 years here in the SQC also prescribed that the requirement of 7 years there. And today, for explaining these requirements, we have a very eminent speaker, CA Mohit Bhaturia, who is also the EAC member, Expert Advisory Committee member of this year in ICI. And he has also participated in many study groups of AASB, like preparation of standards for LLPs and the CNAG direction, which is under preparation. We are also preparing this guidance on section under section 143 subsection 5 of the Companies Act 2030. So I welcome you, sir. And I would also like to tell a brief introduction about CMO Bhaturia ji. He's an insolvency resolution professional and a registered valuer. He's also the managing partner of AC Bhaturia and Company Chartered Accountant. He is a distinguished chartered accountant and insolvency resolution with experience of uh, more than 1,000 statutory audit in the PSU banks and private sector companies. He has also the experience in the subject of corporate law, taxation, valuation, and financial restructuring. So I welcome you, sir, here in this webinar. Kindly share your insight and experience with the participants. Thank you, sir.
Yeah, thank you. Thank you so much, Meghaji, for the nice introduction. Thank you, AASP, for inviting me to deliver this talk. A very good afternoon to all the participants present here. So today I'm going to speak on two standards on auditing, which often discussed separately, actually work hand in hand to ensure that the quality and credibility of our audit is not compromised. So we'll be discussing SA 230 on audit documentation and SA 250 on laws consideration of laws and regulations in audit. Now, coming to SA 230, you see, audit documentation is essentially the record of our audit work. The audit file tells us the complete story of what we did, how we did, when we did, and what were the conclusions we reached. So, SA 30 requires that documentation should be number one, sufficient and appropriate. It should be comprehensive. It should be complete. Complete in the sense that it should support the conclusions reached by the auditor. Uh, as Meghaji was saying in her opening remarks, what is not documented is considered not done. In practical terms, say if we have identified a risk, tested it, found no issues, but we did not document our procedure and conclusion, it is as if we have never tested it at all. Tested it at all. So, from regulators' perspective, also documentation, is very important. And a second point on documentation is that it should be assembled on timely basis after the audit and retained for the period of 7 years. So when I say timely basis, we'll although discussing this in detail, the audit file cannot be tampered after we have signed the audit report. It should be assembled within not more than 60 days from the date of conclusion of the audit. And by assembling mean you can arrange, rearrange, sequence the papers. No evidence can be added or no evidence should be added or no procedure should be added subsequent to the date of the audit report. So we'll discussing this with see some case laws, some cases and all. Coming to SA 40 to 50, while SA 230 focuses on how we record our work, SA 250 focuses on what we need to remain alert during the audit, especially the risk of non-compliance with laws and regulations. Now, we know the director responsibility statement, even management is concerned about compliance with applicable laws and regulations. And we have seen often at board meetings, directors, especially independent directors, expressing their concern as to how the company is in compliant with all applicable laws and regulations. And many of the companies at quarterly board meetings ensure that the CEO, CFO, the company secretary puts in requisite documents, requisite certificates so as to satisfy the board that yes, the company is in compliant with all applicable laws and regulations. Some produce certificates, some give a checklist, detailed checklist in concerning the major laws which are applicable to the company, and against each of the potential compliances, appropriate remarks are given, which are certified. Many companies also try to get it audited, these compliances audited. Now, every entity operate within a web of laws. It may be a corporate laws, tax laws, labor laws, environmental laws, and many other laws, certain industry specific laws, certain licenses. As auditors, we are not experts, but SA 250 places responsibility on us to obtain reasonable assurance that the financial statements are free from material misstatement due to non-compliance. So therefore, it is important here to distinguish what are the direct effect laws that directly impact amounts in the financial statements, such as maybe income tax, such as maybe Companies Act, and there may be certain indirect effect laws, say for example, environmental laws, labor regulation, where non-compliance may not directly change the numbers but can have serious reputational or operational consequences, and in some cases, violation of these laws may have also financial consequences as well. Now, so we'll discussing about, yeah, I'm just sharing. So these are about two laws which we'll discuss. So let us start with SA 230. Now this is visible. Yeah. So we'll talk about audit documentation. But before we go to the main standard, and practically let us understand what is the expectation of the regulator, what regulator found during the course of their inspection or during the review made by the auditors, a summary of the points, critical points which were made by the auditors in the course of QRB findings. Now, not preparing audit proper documentation does not provide a sufficient and appropriate record of the basis of audit report. Now, this was one of the finding by one of the QR reviewers during the course of QRB of a company, and these are the summary which the QRB report says. So there are no checklist in the audit documentation for compliance with auditing standards. We have more than 40 auditing standards, SQC, SRE. So how do you comply with each of the auditing standards? There is no checklist for that. The auditor did not maintain a checklist for that to demonstrate as to how he has complied with external confirmation. How did he comply with materiality? How did we comply with sampling techniques? That was not there. So it was deemed there is no documentation. So who performed the audit work? When the work was complete, who reviewed the audit work and the date of such review? So generally in firms, either article students, article clerks, or chartered accountants go, they work based on the audit particular audit program. That work has to be documented, dated. That work is again reviewed by a supervising partner, or what we call the engagement partner. So again, he reviews the work, he gives the date, he puts his signature. Those things were missing in the audit file. For Caro, company's auditors report, we are required to report on more than 20 clauses, with each clause having more than two sub clauses. Now, for the Caro, say for example, we are stating that the auditor is maintaining proper records. The company is maintaining proper records showing full particulars, including quantitative details and situations of fixed assets. Fixed assets have been physically verified by the management and no discrepancies were noticed. Now, for this, one needs to have a checklist, a document as to who conducted the physical verification, who gave instructions for the physical verification, whether the management had given a copy of the physical fixed assets as well as the book fixed assets when it has conducted the physical verification, whether any discrepancies were noticed on verification, whether those were material. For all these, we need to have a documents, supporting documents as well as checklist. Those things were not present. It was the Caro report was there. Maybe some manual remarks were there in certain documents, but checklist for A separate checklist for maybe Caro, separate checklist for Schedule 3, separate checklist for compliance with auditing standards, for accounting standards. This were not there. Now, in manufacturing companies, generally, we give a note on impairment. We conduct impairment testing. Management provides data. Management gives a working on impairment. We test, we verify the assumptions, and then we conclude whether impairment of fixed assets or impairment of intangible assets is required or not. Now, those documents, those test reports were not available. Only a note was given. Similarly, lenders impose financial covenants. Now, whether those covenants are complied with or not, there is no document of even restrictive covenants. Like in many institutions, give a covenant that so long as you have borrowed money, the amount of existing unsecured loans will not be paid. Say one of the covenant is generally it is there. Now, whether that has been paid or not, that is secondary, but what are the restrictive covenants which the auditor needs to verify? First, it needs to be documented. So that was not documented. Again, if we talk of contingent liabilities, in most of the financial statements, there are and will be some contingent liabilities. It may be on account of income tax, it may be on account of GST, any other indirect tax, it may be on account of any other law. So, what is your analysis and conclusion of contingent liabilities? So, to the effect, it is stated that there is an income tax demand of 100 crores. It is on account of, say, certain additions on account of A, B, C, D, four items, which has resulted in a demand of 100 crores. Now, management says that we have preferred an appeal, and there is a good chance of winning based on some legal cases or based on some legal opinion obtained, and therefore no provision is considered necessary. Now, first, auditor has to document all the contingent liabilities, have the copies of the all the orders. Now, auditor needs to evaluate as to whether the assertions of the management that this contingent liability is not likely to crystallize into an actual liability based on decisions. Again, the auditor has to evaluate all those decisions, make a short note, make a note, appropriate note of what are the all decisions which the management has relied. Auditor also can come to his own findings of other decisions which support the contention of the management that yes, uh, based on these decisions, there is likelihood that the addition would be deleted. To say, for example, a company has incurred expenditure on, say, corporate membership of clubs, to give an example, or company has incurred certain business promotion expenses, advertisement expenses. Now, those in this insofar as it relates to corporate membership, there are large number of decisions which favor that yes, uh, these are allowable expenditure in connection with business in business. Now, the auditor should, in respect of material items of addition, document as to why, along with case laws, reference of case laws as to why it is not likely to be crystallized or why the demand is likely to be deleted when appeal is going to a higher forum. Only taking a legal opinion also from any lawyer is not sufficient. We have seen NAFRA has come on very heavily when auditor merely says that I have relied upon a legal opinion without application of his mind, and it is said that you are responsible for the legal opinion which you have relied upon. So again, one is to document this properly. Going concern assessment. So there are enterprises which have uh, liabilities in far excess of assets, which have a negative net worth. The solvency, the balance sheet depicts that solvency may be an issue for them, but still accounts are prepared on going concern basis, and there is no document to substantiate that the assumption of going concern which has been used in the preparation and presentation of financial statements are accurate. So this is again one issue. When it comes to inventories, so institute through its materials, our auditing standards, accounting standards say that physical inventory should be verified at least once in a year, at least once in a year, if not more. And auditor may not verify it physically, but it should be in the presence of the audit. The auditor should supervise the physical verification. So there would be, inventory sheets. What is the book inventory? What is the physical inventory? If there were any excess or shortage, how the management has dealt with it, whether the auditor has found appropriate answer in case the shortage or excess is material, what is the method of valuation, cost, NRV, whichever is lower. So whether that cost, NRV, all are documented and mentioned in those sheets, and valuation is done on lower of cost and NRV. What is the cost formula used, whether it is FIFO, weighted average. So all these things must be there in the audit file so as to demonstrate that yes, the auditor has verified the inventory. Now, when it comes to trade receivables, intercorporate loans, many times one just verifies the invoices. There is no system of external confirmations. So generally, in case of trade receivables, again we have to have audit documentation as to extra material. Once we have determined what is the performance materiality and overall materiality, then confirmations are sent to the trade receivables for material amounts. Now, in case they are not responded to, again a second confirmation is sent generally. Even if they are not responded to, therefore the question arises as to how the auditor would verify. So auditor takes the invoices on sample basis and verifies the trade receivables with reference to the invoices, with reference to the delivery of the goods made, and maybe with reference to also the subsequent year's accounts where payment would have been received in respect of trade receivables. Again, documentation in respect to ICFR internal control, how test of controls have been made. So again, the findings were that you have collected all the file, but they have not linked it to any audit program or account balance. There is no cross referencing. Maybe you have everything is the in the file, but those things are neither cross referenced. Those things are not indexed. Those things are not properly arranged. Again, that is also a very important point. So common lapses in there are no self-speaking working papers. So what the standard says that your audit file should be such that any experienced auditor, if we would have traveled from page 1 to page 100 of your audit file documentation, he could have understood very well as to in what manner you have performed the audit, what were your observations, what was the assertions, what were your significant matters of significant judgment, how you have dealt with those significant matters of significant judgments, all are quite well evident once document is there. Now, audit program, as I said, audit program is there, but no references to supporting document in audit program is there. One has identified a weakness in internal control. That has not been communicated to those charged with governance. So many a times audit notebook, the articles and the chart accountants who go to the audit, they prepare working notes. That only forms part of working paper without they have been formally documented, reviewed, and sent to client for comments. And many other time those observations are there. Maybe comments of the clients are also missing. So no document in no not documenting inputs from manager oblique partner before commencement of audit, non-performance of final review of the audit at the time of completion, not documenting study material and sources referred during the course of audit. So these are n number of points. Even in many a times appointment letter is not there, ADT one is not there, engagement letter, management representation letter in there. They are very important. Engagement letter is quite important, which should be obtained before the commencement of the audit. And engagement letter is not only reference to the statutory audit, but it would be with reference to all assignments in respect of all services which we render to a particular client. It may be a statutory audit, it may be a tax audit, it may be a certification work. All those matters should be documented in the engagement letter. So during the course of audit, we require representation from management on various aspects. Many a times we write multiple times to the management and seek representations, or many a time one comprehensive management letter is provided concerning all items in the financial statement. So that is also fine. Before we start, we should have knowledge of business, the knowledge of business and environment in each which operates. That is also not there. Many times UDIN is skipped to be generated. So these are n number of things which I thought we should point out before we embark upon a discussion on this standard, on this essay. So the legal requirement stems from Section 143 that auditors should comply with auditing standards. And second schedule of the CA Act also states that a member in practice shall be guilty of misconduct if he fails to invite to any material departure from generally accepted procedure of audit. So the scope of audit, in light of what we have discussed, to give more clarity, it's auditor's responsibility to prepare audit documents for audit financial statements. Specific documents requirement of other essays do not limit. So we have a standard on materiality. As per materiality, we have to determine materiality. Again, for that, we have to prepare a template, uh, a plate. We have to perform external confirmations, unconfirmed. Again, that for we have to have a list of documentation. So all those are again additional items. Laws and regulations may establish additional requirements also to prepare. So, as we said, it is a record of what we have done, how we have done, when we have done, what was the audit evidence obtained for reaching a particular conclusions. So, whatever we have done, that is quite well documented. It is not all things can be documented, but yes, documentation should be so as to enable, as we call an experienced chart accountant who very well knows the subject, that how a person who has conducted the audit has performed the audit. So audit file can be physically, it can be kept on electric form. That is again a choice of the auditor. It contains records that comprise audit documentation for a specific engagement. So before we start a audit, or before again we take up a client, we perform the procedures as per SQC1. Once that is done, we seek appointment letters. We give the letter of eligibility. They appoint us at the first board meeting, or again may appoint at a general meeting. Then they give us the copy of the resolutions, board minutes, and then even uh, the copies of Form ADT1. Then we enter into engagement letter after discussion. Then we have and try to understand the business and entity in which it operates. We have discussions with the management, and based on discussions, we draw the audit plan. So all these things must be there and must be documented. So as I said, an individual who has practical audit experience and reasonable understanding of audit processes, essay, applicable legal requirements, business environment in which entity operates, auditing and financial report issues will be very well able to understand as to how the auditor has performed the audit. There are different stages, starting from pre-audit stage, planning stage, execution stage, and conclusion. These would be the stages of audit. In planning, we would have audit plan. Would have materiality. In execution stage, we would have documented what all we need from the management, how the analytical substantive procedures would be performed. In conclusion state, whatever findings are there, that is communicated to TCWG, or for that matter maybe audit committee or the board. And then conclusions reached, all those are documented. So audit documentation, as we said, why is it important? Because it supports our decision. It tells a regulator, or even our partner or reviewing partner, or other professional bodies like institute, when we are subject to peer review, or when we are subject to review by QRB or NAFRA or SEBI or any auditor, as to what we have done, how we have done. If we have taken a view on a particular liability, say a contingent liability which is not provided for but disclosed, then we have appropriate document to justify that why it has not been provided. Those things are there. So what is important is, at that relevant of point of time, what was correct. It is not that subsequently some order has come of a high court or a supreme court which has reversed a particular tax position which may have been taken by a client. What is relevant at that relevant of time point of time, what was more important. Many a times there are two views on a particular facet. Say a particular tribunal may have given one view, another may have given another view. Often we consider our jurisdictional court. In case we have favorable decision of a jurisdictional high court, and there may be a unfavorable decision of a different high court of a different jurisdiction. In case we have a favorable of our jurisdiction, we can rely upon that. We rely upon that. But let us say we do not have a decision. We have a contrary decision of our jurisdictional high court, but maybe a favorable decision of another high court. Then it becomes quite difficult for the auditor to evaluate as to why the management would like to show the liability as a contingent liability and not an actual liability. So again, these are matters of judgment. These are matters of deep analysis of tax laws. So, and all should be documented. And I said it is the backbone of the audit. The work that auditor performs, explanations given to the auditor, what we call information and explanations received during the course of audit, conclusions arrived at, are all evidenced by documentation. Inadequate or improper documentation may be considered as deficiency, or no audit is conducted. We may have done everything. However, is no documentation, it may be question on work done in case any material misstatement is reported. Many a times we discuss when we address at seminars. Again, many SME practitioners says that having regard to so many accounting standards, so many auditing standards, then requirement of CARO, then requirement of Schedule 3, then maybe requirement of the regulator, say if a company is an NBFC, requirement of RBI Act, directions, the volume, the size of the documentation becomes too complex, too voluminous, too complex. Again, answer is that uh, it is documentation is no substitute for anything. If you are to prove that you have done an audit in a way as is required by the SA, applicable SA and the applicable law, that document would, prove that yes, you had conducted it. And this especially becomes very important in case often we have seen in the last in the 5 7 years how the regulators are, up their sleeves against the auditors for, in case anything it happens in the balance sheet, auditor is hauled up. And in such situations, if proper documentation are not there, then auditor, it will be very difficult for the auditor to defend himself. So as we said, the nature and purpose is it assists engagement team in planning and performing. It is an evidence of planning as per regulations. It assists in review. Again, it creates in accountability. One, when rights as to why contingent liability has not been provided, or why he has taken a particular accounting view in respect of a particular transaction which are of significant matter. Once all is written, documented, once you write, there is an accountability. One cannot write whatever he can. So again, he applies his minds when he documents it. These are matters of continuing significance. It is an evidence of our basis for conclusion. It assists in external inspection, internal reviews, supervision, and direction. So these are the, some objectives of audit. Again, documentation uh, supports compliance with standards. It is an evidence that audit was planned and performed in accordance with applicable essays and legal and regulatory requirements. Now, the form and content, again, it depends upon the size and complexity. Maybe for smaller units, the documentation could be far simpler. Again, it is a matter of judgment of the auditor as to how, to what extent the document can be simplified. The nature of audit procedures to be performed. If the number of analytical or substantive procedures to be performed are quite high, having high, then perhaps the documentation would be more complex. Identification of risk of material statement. So if there's an NBFC, say for example, lending to smaller entities, there are many fintech entities. So they would have, thousands and thousands of clients to whom they have lent, and we have uh, very small, uh, in small amounts, 1,000 rupees, 2,000 rupees, 5,000 rupees. So the risk of material misstatement of not identifying an NPA, becomes quite challenge. So again, the audit procedures have to be commensurate, documentation has to be commensurate. audit methodology and tools. What methodology and what audit tools? There are many tools now available in the market. Again, your documentation again would depend upon what audit methodology. Many firms use now audit software. Again, software is also something a part of your documentation only. Now, what is important is certain significant matters. Issue We have key audit matters, we have significant matters. So there may be, as I said, an item of say contingent liability, or say uh, the company wishes to change the method of depreciation from one method to another, or say it is a is a complex transaction of a lease, and where one has to evaluate whether it is a per se simpler sitter lease or it is an ROU. So there, it may be significant matters. So these have to be documented. These have to be again documented. Maybe management would give his assertion as to why it is wants to treat and particular lease transaction not as a simpliciter lease but an ROU. Auditor again would evaluate in line with the requirements of the accounting standard. Again, auditor would document as to why that particular lease agreement is not a simpliciter lease but a ROU asset, or why it is not an ROU, or why it is not a lease. So all those things, again need to be documented. There may be certain matters which would be determination of key matters. Again, in conjunction, in discussion with the management, auditor would identify a receivable may be a key audit matter, inventory may be a key audit matter, impairment testing may be a key audit matter, review of contingent liabilities may be a key matter. It all depends upon what is the extent, what is the materiality of all those items to be, and complexity of those items to be determined as a key audit matter having regard to SA 701. So it is important to communicate. So let us say management has determined a particular item as an ROU. Auditor has to write and inquire from the management as to, assuming it is a significant matter, as to why have you treated this agreement as an ROU. Management would respond with copies of agreement and its findings in line with the requirement of accounting standards. Auditor needs to itself evaluate whether those uh, you know assertions of the management and the rationale for treating a particular agreement as a ROU is correct or not. All those should be documented. There may be, at times, one may depart from the requirement of a particular essay. In case there is any departure, one has to document. Ordinarily, there should not be any departure from the requirement of an essay. But in case it is, uh, one should document how alternative audit procedures were done to achieve the aim of the requirement of the standard, reasons, and to report to draw attention to the departure. Those all should be documented. In certain circumstances, it may so happen that auditor performs additional procedures, draw new conclusions. That after the commencement of the audit, evidence came to uh, new evidence came, new which was not there at the time when the audit was performed. Now, if these evidences, in the light of the evidences which were there but were not to the knowledge of the auditor, was not brought to the knowledge of the auditor, again, auditor has to evaluate those evidence, reach conclusions, and keep a record whether there is an effect on audit report or not. Revision or not revising is something again auditor needs to evaluate, but all those findings on account of subsequent evidence received must be documented along with conclusions reached, the effect of on audit report, who made the review, who made the audit documentation, when it was made, along with date, time, everything. Now, coming to types of files that we have been doing since ages, that we have two files. One is the permanent file, one is the current file. Permanent file contains documents which is not restricted to one time period, often used year after year. It say, for example, memorandum and articles of association. But if amendments are made again on a yearly basis, we take from the management that since the last MOA, AOA, what were the amendments made to your MOA? Because MOA and AOA are the fundamental documents of the company. One cannot travel beyond MOA for carrying out any business. The regulations, as far as the articles are concerned, the company has to abide by its articles of association and subject to the requirements of the act. Engagement letter, communication with previous auditor. So whenever a new assignment is taken, new audit assignment, NOC from the previous auditor should be obtained, and that NOC should be obtained before communication of acceptance. So we give the consent letter, we give the declaration of eligibility, certificate of eligibility, management appoints at a board meeting, at a general meeting, it issues the appointment letter. So before accepting the appointment, one should see that the undisputed dues of the auditor has been due, of the previous auditor has been paid, NOC has been obtained from the previous auditor, only then one can give the acceptance. The permanent audit file would also have the constitution of the client, acts and statutes which apply, a short note on the organizational structure, history, and background of the entity, list of directors, and so on, legal documents and lease agreements, shareholders' agreements, copies of special resolutions, copies of various important contracts, agreements, minutes. So all these are contents of permanent file, and many a times clients do not like to part away with the signed copies or the Xerox copies of various documents. So in that case, what do? We make note of the salient important terms and conditions of the agreement. When it comes to minutes, because minutes are of paramount importance to the company, it contains their business details. Again, sharing or what you call, in case they are misused, it may, severely hamper the business and interests of the company. So they provide the minutes and whatever all is relevant to the audit of financial statements, date wise, those summary of the minutes, summary of the decisions again are documented by the auditor. So we write, like say, but first board meeting was held on 7th April. So what were the important items, important resolutions passed or important discussions which were made? All those are tabulated and summarized in a Word or an Excel file. Now, current files, something which is to be prepared year after year, maybe a fee letter in case every year we send a separate letter for the fee, audit plan, audit programs, queries raised, explanations received, third party confirmation. Nowadays, generally, when it comes to confirmations, things are sent by mail. So the copies of the all mail or the archives or the all the mail are again uh, saved in the computer. Correspondence with auditors, accounts, annual report, management representation letter. One important point regarding management letter, generally we take a management representation letter, but it needs to be seen whether it has been authorized by the board to that particular person who has issued the management representation letter. So generally, when we take the management letter, and what is again important is that before we sign the financial statements, it needs to be seen whether the financial statements were duly approved by the board. So many a times it happens, a board meeting takes place, uh, the management approves the financial statement. At the same meeting, the auditor is also present. It is required to you know uh, sign the financial statement. So in audit committee meetings, generally auditor is present, not at board meetings, because audit committee discusses, before the audit committee, auditor has to give a presentation on the financial statements. What was his scope? How did he carry out his work? What are the major points which we would like to draw attention to the audit committee, so on and so forth. But at board meeting, generally auditor is not there. So usually we ask management to give us a certified copy of the resolution. Maybe minutes are not available because same day we have to sign. So minutes are not available. We take a copy of the certified copy of the board resolution. Even when it comes to the management representation letter, we make it sure then the management writes that this management letter is issued under the authority of a board. And for that also we subsequently seek a resolution that the gentleman who is giving the MR has the authority to issue the MR. So again, the current file would have communication with TCWG management. Now, here there was a point which was raised by the NAFRA that your audit documentation does not, you know, specify who is TCWG. You have not identified TCWG, whether it is the audit committee, whether it is a board, whether it is senior management. Who is TCWG? That again needs to be identified. So what to document? The audit procedures applied, the objectives, the procedures, the results, the conclusions, the details of test performed, all those details of test as we have discussed, along with the conclusions, the basis for conclusions, cross-referencing, indexing, all those things should be done. Audit procedures performed according to instructions in the audit program. Only the work, what to document, work actually performed, and only what is relevant to the audit. What is not relevant to the audit but does not support the analysis, conclusion, opinion, that need not be documented. It can be in electronic, manual, or other media. So these are examples of what are documentation, audit programs, emails. Even emails, we take as I said, take a backup and put it on the hard drive. Analysis, test of details, confirmation, representation, copy of important contracts, substantive procedures, all those are part of documentation. Invoices, even we take out invoicing for testing. Now, very important. So a company identified the materiality, and based on materiality and sampling, it said that I have done 50 purchase invoices, but it does not have the details of the purchase invoices. It is not necessary that all 50 invoices should be with the auditor, but yes, the details of the invoices must be there, and that must have been properly documented as to when the PO was issued, when the material came, who issued the purchase order, what is the purchase, say invoice number, date, who is the party, what is the invoiced amount, what is the taxes, what is the other charges, what is the total, and then who reviewed this purchase invoice. So all those documents, all those information, details of invoices also must be there in respect of the you know purchase invoiced, examined, vouched. Duplicate documents that can be deleted, destroyed. Typographical error, many a times we create documents, and that maybe those documents are overridden. Say management gives us a balance sheet, and that balance sheet maybe once, twice, thrice it undergoes change due to number of reasons. So one can keep the last copy, last one, and the rest of the financial statements which have been overwritten or a number of times, they may be destroyed. So, when it is not required, if you do not have internal audit, one can write not applicable. Then there is no separate requirement to prove that there was no internal audit. If internal audit is first, whether it was there, whether it is required by law. If not, then there is a point why that internal auditor was not there. If it is not required by law, whether internal auditor was there or not. If yes, under both situations, then if findings of the internal audit report would have to be summarized, it have to be documented. Copy of internal auditor report needs to be obtained. Those findings summarized, and to see whether they have any material impact on the financial statements. Generally, those observations of the internal auditor, if they are material, management is asked as to how they intend to deal with all in the financial statements. If there are control gaps, then again, those are discussed to identify what weaknesses the internal auditor has identified, if there are non-compliances of laws, regulations, as to how the management intends to address that. All these are documented, and only in the auditor in Caro also we have a point whether the observations, the report of the internal auditor has been duly considered while drawing your report. So those things would be there. For small and less complex entities, it is less extensive because many a times in small entities, say the proprietorship firms, it is the audit team, the article clerk, and the engagement partner who carries out the work. Unless it is a listed company, in case of a listed company, we have to again have a review partner. But in case of unlisted companies, unless law requires, it is for smaller entities, it is less extensive. So auditor may record various aspects in a single document. Again, it depends upon the size, complexity of the entities. So characteristic of what we call high quality papers. So what are the characteristics of a high quality papers? Completeness. Each working paper should be complete, self-standing, self-explanatory. It should be accurate. It should be organized. It should be relevant. Irrelevant paper should not be there, and concise to the extent applicable. So there are specific document requirements in all the standards. So the requirement of essay, other essay is in addition to essay 230. So all those documents which are specifically prescribed in the other standards, for example, related parties using the work of internal auditor, ca- CAM, other information, all those documents, whatever is required in relation to other standards materiality, that should again be properly documented. And it is a illustrative working paper format which is given even on our implementation guide. uh, One can have illustrative working paper in this format. Now, assembly of audit file. So as I said, assembly of audit file should be done within 60 days, not more than 60 days after the date of audit report. This file has to be preserved for 7 years, and one cannot one cannot add any new audit procedure, new audit finding after the completion of the audit. So basically, if I have to say what we are required to do, so we may have conducted the audit, we may have an audit file, which may be in hard, which may be in soft. There may be hundreds of files in the computer, but they are not organized, they are not indexed, they are not cross-referenced. Standard says you can only, rearrange, index, reassemble the file. You cannot add new evidence. You cannot have conducted a new procedure and added subsequent to your sign off on the audit report. So this is very important. Even we have seen, Nafra pointed out cases that what they have seen, that after sign off, new evidence has been added. After assembly, within 60 days, beyond the date from signature, you have tampered with the audit file. So if things are uh, maintained in electronic form, one can the date of revision is well available in the audit file, in the Excel or the Word or whatever software we are using, that is available, trail is available. So one regulator has been able to make out that, look, you signed the balance sheet on 1st June, by 31st July your file assembly should have been complete, but we found that after 31st July you have rearranged the files, you have indexed the files, you have added new evidence. So then that the regulator does not see in good picture. So we can discard, delete, supersede document, we can sort, collate, cross reference, we can complete the checklist. So but we cannot do anything to a new procedure cannot be done after the audit, or maybe we have performed, you see, as we are discussing on contingent liabilities, we have evaluated, but all the documentation relating to the preparation of notes as to why we consider a particular liability as a contingent liability and not a provision, all those have been documented, prepared subsequent to the date of audit report. That is not acceptable. See, ownership of audit file, it is the property of the auditor. Auditor may at his discretion make extracts and make available to the client, provided it does not undermine the validity of work and does not undermine the independence of the auditor or his audit personnel. And the ownership of the audit file, at times, in case it is required by law or on a particular regulator, the audit file has to be shared with the regulator. As we see now, NAFRA says that when a particular client is selected for inspection or review by NAFRA said that you send us the complete file from along with an index from page 1 to page 100, 200, along with a letter or an affidavit that this is your complete audit file. So we will not entertain anything after that. Based on that, we evaluated whether you have complied with requirements of all SA, CARO, accounting standard, other applicable laws, CAM, whatnot. And in case we have any query relating thereto, we would shoot you, our observations so as to reply. But anything and everything which you will do should be supported from the file which is available there. So timely preparation of audit documentation, prepare sufficient appropriate audit documents on a timely basis. It enhances quality of audit. It facilitates effective review and evaluation of audit evidence, conclusions reached. Document prepared after the audit is less accurate, definitely. So key takeaways we have discussed number of times. We have that their audit documentation on a timely basis is key to documentation should be prepared to understand the nature, timing, and extent of audit procedures to comply with SA and other legal regulatory requirements, the results of audit procedures performed, audit evidence obtained, significant matters during the course of audit, what were those significant matters, what was the conclusion reached, what were the judgments made, communication with TCWG, prepare a simple work paper, indexing, cross-referencing, and these are the key takeaways from what we call the SA 230. So documentation, as you said, whatever we do, documentation is extremely, extremely important. Now, having done, let us take some case studies on SA 230 before we go to 250. A few case studies. And in case you have any questions, you can put on the chat in case you have any questions.
Uh,
I'll try.
Hello. Hello. Good afternoon, sir.
Yeah, good afternoon.
Sir, I am Vivek Kumar from WSP.
Yeah.
Sir, we have received a question from participants that if some documents, sorry, sir, if some documents are confirmed through management representation letter, but actually received after the auditor has signed the audit reports.
No,
So,
then
so
this correct.
yes.
Correct. So I presume you have received certain documents after audit report. Then the question arises: how did you evaluate and came to the conclusions? Let us say theoretically there was a contingent liability. There were certain orders, and you said that you received the order after the date of the audit report. Then the question arises: how did you arrive at the how first you verified this, examined this, reviewed this, came to a conclusion? So at times, if I have understood the correction question correctly, this is what I have to say. But say uh, uh, in case, say for example, we have reviewed the lease agreements, right? So at that point of time, management said, no, we'll not. These are very confidential documents, so we'll not allow you to take all the document. But yes, you take extract thereof. So we have taken extract thereof. We have performed the procedures. But then we insisted that no, you should have given us the lease agreements. Of course, we'll sign with an NDA with you. We'll not share. So maybe we did all the procedures. We prepared the report. At that time, it was not there, but there is no no impact on the our conclusion based on whatever we have supplement. Then subsequent to the audit, maybe the management has sent us a copy of those lease agreements. So then that is fine, that would be fine, because these lease agreements have already been extracted, documented, and we have performed all the test, analytical, substantive, whatever we have to perform, and based on that we have drawn our conclusion. In that case it is fine. But In case those have not been done and subsequently through a management representation letter it is received, and as such the management representation letter should also come before we sign off the balance sheet. So that is important. I hope I have been able to address your query.
Yes, sir.
Yeah, thank you. Now we come to certain cases. So this is visible.
Yes, sir.
Yeah. So see, we make provision for doubtful debts, right? So auditor, there is a disagreement between the auditor and the management. The client said the provision should be 10 lakhs, auditor said 16 lakhs. Then there were multiple meetings, and finally, the provision was made for 40 lakhs. Now, as to how one auditor reached from 60 to 40 or management reached from 10 to 40, that was not documented. So what the auditor had in his file, that the provision as per the auditor, the provision is 60 lakhs, and in respect of that the workings, the calculations and supporting papers were made. But from 60 to 40, how it was finalized, those documents were not there. So provision is a matter of significant judgment, and failing to document the rationale uh, and absence of documentation for such a significant matter as to why from 60 to 40, this means that the auditor did not sufficiently consider or support the provision decision. So as I said, no document, no audit. What SC 230 says, that auditor must document significant matters, professional judgments and conclusions reached during the course of audit. Determining the provision involves judgment, so it falls under significant matters that require documentation. Therefore, the auditor should have prepared a working memo as to what made it settle at 40 lakhs, why 40 lakhs was appropriate, key discussions with the management. Maybe when the auditor has evaluated, he may not have considered a particular amounts correctly, the past provisions correctly, so aging analysis correctly, past recovery history correctly, and the working paper should conclude why the agreed amount is deemed reasonable in the light of the evidence. So you have done at 60, now you come at 40. So maybe at the time when the auditor would have documented 60, it some assertions, some amount, some details may be not correct. So when it was made from 60 to 40, that document, final document for 40 should have been there in the audit file. So, retrospective wage settlement is not new. Many companies have retrospective wage settlements, and say a company signed a retrospective wage settlement which results in payment of wage areas of 100 crores. These final statements were adjusted. The wages recorded, gratuity provision increased. Auditor discussed this with the management and TCWG orally, ensuring the auditor thought, yes, TCWD audit committee all are aware. So he saw the wage revision, he saw the gratuity calculations and everything, and he, you know, discussed orally in the management, and auditor believed that because management and the board already know about the issue and adjustment, there is no need to document these discussions in audit working papers. First, is it a significant amount or not? Yes, it is a significant as well as an exceptional matter. Relying on oral communication is quite risky. What SA 30 says, to document discussions on significant matters with management, TCWD, including the matters, the nature of the matters, and when and with whom the discussion should have taken place. So, ideally, what auditor should have done, there could be a memo or note summarizing that, look, there is a retroactive wage agreement, 100 crores, the financial impact, both increase in wages, gratuity liabilities, his discussions with the CFO audit committee, TCWD, when, and conclusion decision. And even though management and the board were aware, auditor document should reflect that these communications occurred and what was revolved. So what was needed to be done, that was well done, but what was done, that was not documented. This is the case. Because It is a matter of significant. Assuming it would have not been significant, assuming for say, then maybe this documentation would not have been required. Now, cross-referencing. See, this is very, very important that uh, in the course of hiring, there are significant risks during planning, and these are not either not linked or cross reference to specific audit procedures in the program. So, revenue is a very important matter in the financial statements, and there is again a risk of misstatement of revenue, risk of fictitious sales, maybe sales as at year end have not been recorded. Audit program was a generic checklist and did not highlight what procedures auditor would and perform for that risk. The audit team believed that documentation is fine since both risk assessment and audit program are in the file. But evaluation of this risk of fictitious sales or non-recognition of revenue, which is a material item, was not there. Now, what essay says that the audit documentation should show the link between the assessed risks and work performed. Here, 315 comes into play and it requires documenting identified risks of material misstatement. Further, SA 330 requires documenting the nature, timing, and extent of audit response to those risks, including linkage to the assessed risks. So, accordingly, the what would be the cutoff procedures? What would be the additional test procedures? What would be the cross referencing? All should be there in the audit documentation. So, yeah. So, in the subsequent case is similar to say this case where, as I said, sales, testing of revenue. There was a generic checklist for testing of revenue, but not about a higher level of risk of material misstatement in case of an hotel company. So generally, how do we do this? We try that to for evaluating whether all the revenues are recorded. Then the last 5 day bills and the first 5 day bills of the next year are are test checks to see that there is no non-recording or suppression of sales. Maybe the sales of the relevant year is not shifted to that of the subsequent year, or the sales of the subsequent year is not shifted to the sales of the current year. Again, there is an uh, analytical procedure as to what was the percentage of revenue in the last year, what was the room occupancy in the last year vis-a-vis current year. So those tests are again are performed, generally performed. What is the ARR in the last year? What is the ARR in the current year? In the last 5 years, assuming in the last 5 days of a particular year, say hardly there were sales, hardly there were occupancy. We try and find out what is it seasonal. Maybe in the last year also the occupancy in the last week was 35%, but the whole year was 65%. All those things are these are additional procedures, additional assertions for which the audit program should capture these facts. This is change plan. Yeah, physical count. So this is very important as we discussed. Uh, you know, physical verification of inventory. All items of inventory should be verified at least once a year. Auditor need not be a party to the physical verification, need not physically himself verify, but yes, he should observe the countings made. So at times there is a team of 100 people from the client side who is performing the physical verification of an inventory, assuming let us say it is a very large factory where you cannot stop the work, like we have seen in many pharma companies where they cannot, they have medicine shops, in-house medicine shops, and it is not possible to, cut off the supply of medicines to the hospital. So they deploy a very large team of 100 people day and night to ensure that the work is completed in a span of 1 or 2 days. 2 days, and in that process what they do, some items of medicine which they think they would be required at the hospital, those are kept separately. Those are kept separately so that the supply should not be disturbed. Now, so auditor would verify, auditor would be a party. So auditor would observe the physical counting which is being made, done by everybody, and one would have the uh, you know physical uh, sheets, printouts which would have the name of the item, the unit of measurement, the number of pieces which are there, and then the side of that one would write what is the physical count, what is the discrepancy, if any, and finally these are all entered in the system. And then what is the cost, what is the market value, lower of cost and market value. All these are all these are the procedures which need to be performed, documented. Many a times it is not necessary that the auditor would be present at all places for physical verification. Then some another person would be appointed to conduct the physical verification under the supervision instructions of the auditor. All those things should be document. Also, those things should be documented. We write inventories are valued at lower of cost and market price. So we have only the cost which is coming from the system as to what is the cost of raw material. But what is the market price? It is not written. Obviously, in case of finished goods, what are the different components of cost? How is the valuation done? That is not here. In case of WIP, again, what are the different components of cost? What are the different products up to what stage they are complete? How much material has been consumed by those direct material, direct labor has been consumed in those WIP, and what is the allocation of the overheads depending upon the you know percentage of work completed. What is the formula, cost formula? All those things are not there. Again, this is one important. Assembly of audit file we have done, and we have discussed. Now, Excel dilemma. You see, many a times it happens that we get very, very bulky files from the clients. So once we get the bulky files, so the auditor at times who performs the audit may have deleted various portions of the files, various portions of data which is available in the files. And finally, it may so happen that a particular work performed or a particular conclusion reached does not is not available from the file finally. So generally what we advise that you take the full file from the client. In case something which is not at all relevant, you may delete that. Else, if it is a relevant data, just to cut short the file, you should not delete the data. Rather, you make a summary of the findings, summary of the file as in a different file, or maybe in a different sheet. Many a times, a file is so bulky, it takes so much time to open that we prepare another file where we record in summarily uh, uh, what are the what are our findings, what are the conclusions reached, and we do not tamper with that file. So again, this is very, very important. So this is a very important emphasis of matter. We give emphasis of matter. We have other matter paragraph, and again we have our modified opinion. For each of these, we need to have adequate documentation. So there was a case where company issued redeemable preference shares which were due for redemption, and the shares were not redeemed on the due date, and negotiations with the shareholders were going on to extend the due date. The auditor, recognizing this could affect future cash flow liquidity issue, included a paragraph emphasis of matter in the audit report. He did not qualify but highlighted the delayed redemption and the uncertainty about this. In the audit working paper, auditor did not document anything about this preferential redemption issue, no memo of conversation of or analysis. So the fact is that there were preference shares, those were not redeemed in time. Auditor came to know of that. Auditor draw attention of the management from an emphasis matter paragraph in the audit report that look, these preference shares were due for redemption, but they have not been received. But no analysis, no correspondence with the management as to why you have not redeemed the preference share. What is your response to that? And based on the response of the management as to why a penalty would not be levied by the regulator for non-redemption of of the preference shares, while Uh, so all those things, working paper, communication with TCWD, nothing was there. Nothing was there. What was the management explanation for non-payment? Are they negotiating for restructuring? So everything needs to be documented by the auditor so as to reach at a correct conclusion. And last, as I said, in case of peer review, these working papers should be complete and self-explanatory so that even when the peer reviewer comes for our review, as I said, as any experienced auditor, he would well understand as to what auditors would have performed, what documents we have taken, what tests we have done, what analytical subsidiary procedures we have performed, what conclusions we have reached, on what items we have communicated with TCWD, TCWG, what are their responses. So everything should be well. Uh, uh, our working papers, our audit documentation should be a speaking audit documentation. So as I said, uh, in that particular, it was a case for a breach of a contract suit where complete working papers were not made. So it was a case where auditor said no provision has been made as legal counsel believes chances of loss are remote. It was disclosed that contingent liability. So the engagement partner should emphasize to staff that the work paper tell the full story, that what was tested, what was evaluated, and how come you came to the conclusion. As we were discussing on the contingent liability of tax matters, that if you are taking a possible view on a particular tax position, on a particular tax demand, what was the view of the management, what was the working note provided by the management, what were the decisions provided by the management, document those decisions, supplement those decisions with your own analysis, and if you are able to come to the same conclusion with the management, then that is fine. Contingent liability remains a contingent liability. So this is all about SA 230, and let us start SA 250. And then we take upon some case studies on SA 250, and 15 last 10 15 minutes we'll keep for question answer. I hope this is visible.
Yes, sir.
Yeah, first. So non-compliance of laws and regulations. So as we commonly say, NOCLAR. So in this the standard deals with what is non-compliance of laws and regulations. So a particular, there are general laws, there are specific laws, there are industry specific laws. For example, in case of company, we have Companies Act, we have accounting standards, we have Income Tax Act, we have say we have labor laws, PF laws, ESI laws, we have environmental laws. So it is the responsibility of management to ensure that they are compliance with laws and regulations. And I said in the my opening remarks that uh, companies are now quite conscious of compliance with laws and regulations, given the fact that penalties, fines are quite magnanimous, and at times we say that in case there are material violations, it may kill non-compliances, it may lead to the death of the even lead to a death of the company. So yeah, you have interest, you have penalties, you have fine, you have additional fees, whatnot. So management are quite management are quite aware nowadays of the potential risks of non-compliances, and they do not want to stand on a get caught on a wrong foot. So in many listed companies, and now even in private companies, we have seen that much emphasis is being made by given by the management in the quarterly board meetings. Whenever it happens, they ensure that uh, requisite certificates, requisite compliance compendiums are put at the board meetings by the respective KMPs and demonstrated adequately to the satisfaction that yes, the company is complying with all applicable laws. Many a times you have seen, like say there is a related party transactions. So as we all know, section 188, it says that all related party transactions have to be in ordinary course or an arm's length. If they are not in ordinary course or not on arm's length, then board approval is to be obtained. And under if the transaction exceeds the specified threshold, shareholder approval is to be obtained. When it comes to listed company, audit committee has to approve. So there were instances where audit committee approved the transactions. So auditor asked, we as auditor asked that look, you have approved the transactions, approve the transactions. You have said these transactions are in ordinary course and arm's length. Ordinary course is fine, we can understand. But how did you say there was a payment of lawyer fees? Correct. So you have documented, or there are payment of professional fees. You have said audit committee has approved, stating it is an ordinary course and arm's length. But please provide us the documentation to justify how it is at arm's length. So management said these are payment of legal fees. They are very specialized services. So we said there is no exception to that. So compliance with laws and regulations, when section 188 says that it has to be an ordinary course, and if it is not an ordinary, if it is not at arm's length, you provide justification as to why, and a rationale why it is not an arm's length and why did the transaction. So it was that look, these are very specialized services, legal services. We cannot, of course, share our document with everybody and try and get quote as to given the complexity of the case, it is not possible for us to go and tell all the lawyers what are our cases. Then the question arose, then how do you justify it, that whether it is at arm's length or not? So in legal profession there is a concept of fees per hour. So then they took uh, codes from uh, same level of firms, as to what are their fees per hour for different grades of associates, partners, senior partners, all those. And then they had able to justify, yes, how do we say that these transactions are arm's length. Similarly, when they enter into transaction of sales of goods, again they need to document. So as auditors, we have to see, yes, whether those documents were there or not. If they are saying at ordinary course, arm's length, those documents are there or not. So I just try to give you an example of a such particular situation. It is not the responsibility to find out all instances of non-compliances of law. It is not auditor's responsibility, but yes, it is the auditor's responsibility to ensure that the financial statements are free from material misstatement due to non-compliance of any laws or regulations. Therefore, the auditor has to take into consideration as to what are the general laws and what are the specific laws applicable to the entity, and how the company seeks to address all compliances with those laws and regulations. So during the course of audit, we come across various cases of non-compliance of laws, which may be suspect, which may have we have identified. Now the standard tells us how to deal with those. So there are payment of legal fees. We have find there are payment of legal fees which the company is making to the lawyer. It therefore prima facie it means that the company is subject to certain disputes, certain court cases, and those court cases are evaluated to find out whether there is a non-compliance on the part of a company of a particular law or a regulation, and then the management is inquired as to what would be the potential impact of those laws and regulations. There may be certain suspected compliance, suspected compliance. So we are saying that the companies, supplying goods to a related party, but those, we found that from internal inquiries, like, look, this company is supplying goods to another company, which happens to be its related party, but that is not documented, that is not disclosed, that is not documented. Now the company auditor will try and find out how come this entity is a related party, and assuming it is there, it would try and evaluate suspected non-compliance. So if the suspected non-compliance is serious and serious in magnitude, auditor, after legal advice, even may consider withdrawal from the in the engagement. So there may be also a requirement of reporting to regulators. Say, for example, in case of NBFC, the Reserve Bank of India says that in case there is any contravention or non-compliance of the provisions of RBI Act and the directions issues thereunder, you have an obligation directly to report to the Reserve Bank of India. And RBI, through its directions, mandates auditors, the management, the company, to write in the letter of appointment issued to the auditor about this fact, that in case there is any potential non-compliance, auditor has to directly report. And if you see, earlier we are reporting directly through hard copy. Now there is a form, NBFC, which is called DNBS 10. In that, there is a column where the RBI asks, has any exception report been filed with RBI? So exception reports, if are there, that when in any non-potential non-compliances, that needs to be filed with RBI, submitted with RBI. So even non-filing of return in time is a non-compliance which RBI needs to be intimated. And during the course of inspection, which has been conducted by RBI, and RBI summons the both the management and the auditors. And in case there are any material potential non-compliances, auditor are even asked by the auditor as to why, by the RBI, as to why these non-compliances were not reported by the auditor to the to RBI. So again, this is very important. So generally, we say that in case first, if the auditor has detected the non-compliance, auditor asks the management to, assuming there is no material impact on the financial statements, auditor asks the management to rectify it. If the auditor, the management does not require it, then the auditor may report to the audit committee or the board, as the case may be. And even if they do not rectify the non-compliance, auditor, if it is material, auditor may consider it to uh, include a modification or emphasis matter in the audit report, as the case may be, depending upon whether it is a material bearing material impact on the financial statements. Now, if it does not have a material impact, then the duty of the auditor is to communicate to TCW as, or the audit committee, as the case may be, of these potential non-compliances, and seek their views on those non-compliances. And this may be documented. So, as I said, it may be something to do with non-compliance of the regulatory framework, non-compliances of law, maybe Companies Act, maybe accounting standard. Potentially, at many a times, we see that there are certain companies which are carrying on NBFI business without, obtaining a certificate of registration. So, in Caro, we are required to report this fact, whether the company is carrying on NBFI activities without certificate of registration. But let us say the company is carrying out this. The question therefore arises whether the auditor should qualify his report. In addition to whatever is required to be stated in the audit report in the Caro, whether the auditor should comply, should qualify this report, should. So therefore, the auditor, in case he finds that such a thing is happening, so is it something which has happened for the first time? There may be a situation where management had a company, had a factory, it had sold the factory. So whatever surplus came, it, say, invested in shares and securities, it, and it earned income from that. And based on the 250/50 test of income and asset, as on the balance sheet date, since both those tests were made, it is deemed to be an NBFC. It qualifies an NBFC, but it is carrying on business without certificate of registration. So auditor would inquire from the management. Again, it has to evaluate. So management may respond that yes, this has happened pending deployment of the amount in the business, and auditor has to review the board plan, business plan, as to what the management intends to do, what they did in the subsequent year. So maybe it is a one-off event, or maybe the management says there is no now. Since we have sold the factory, invested in financial asset, we this has happened. It was inadvertence. Now we apply to RBI for a certificate of registration. So, or it may so be that the management neither has the, it was neither a case of a sale of a factory, but management has been carrying on this business. So, after evaluating all the circumstances, now the auditor has to reach a conclusion whether to qualify his report, whether to modify his report, whether to report to the regulator, because RBI says if you are carrying on NBFI business without my certificate, it is a duty of the auditor to respond whether it is a one-off or two-off event, that it does not matter. If the 50-50 test is satisfied, auditor needs to write to RBI. Again, in the balance sheet, auditor needs to evaluate whether it will be a modified opinion, emphasis of matter, or it may not include any of the two items. That is a matter of, again, of auditor's judgment. So, as I said, it is the management's responsibility, CWD, to ensure that entities' operations are conducted in accordance with laws and regulations. So, auditor has to monitor the legal requirements, see the effectiveness of operating procedures, whether what are the internal controls, what are the code of conduct, how are employees trained to ensure that they comply with, whether they are engaging legal advisors, and whether they are maintaining register of significant laws and regulations and record complaints. So as I said, many companies have now started, maintaining SOPs for compliance of laws and regulations. So as I said, auditor is responsible for obtaining reasonable assurance that they are free from material misstatement due to fraud and error. Auditor is not responsible for preventing non-compliance and cannot be expected to detect all non-compliances. So, but what is important, as I said, it has to ensure that any non-compliances should not have a material impact on the financial statement. What factors increase the risk of not detecting non-compliances? Limitations. If management does not provide information on certain important court cases. So say there are cases which are pending before appropriate court of law. The hearings are taken place, but management does not update on the auditor on what has transpired at those hearings, what document it has submitted at those, what are the cases, what briefs, what petitions, what affidavits. Then there is a scope limitation. If there is a scope limitation, then the auditor may even consider withdrawing from the engagement after seeking legal advice. Now, some laws and regulations relate to operations which may not have impact on financial statements and are also not captured by entities information system. So let us say you are in transport business, you are allowed only X quantity to be loaded on every truck, but every time you overload a truck, and if you overload a truck, there may be penalty imposed on you. So whether this non-compliance is again is material or not material, uh, you are operating a chemical factory, there is a river nearby, so you are throwing the waste near the river, which may have an environmental issues. So again, that may be a potential non-compliance. Collusion, fraudery, these are against other non-compliances. So as I said, what are the different types of laws which have direct effect, which have fundamental impact on going concern? So auditor has to obtain sufficient evidence regarding the compliance, exercise professional judgment, and ensure that they do not have a material impact on financial statement. So indications of non-compliances, we have discussed a few. So there may be investigation by regulatory organizations, government departments, or payment of fines and penalties. So overloading of truck, you have paid fines and penalties, but we find it is repetitive. So it may result in a material. Therefore, there are something which has been detected. Then auditor has to find out whether the management is undergoing it on a regular basis through examination of the records. So therefore, it may be out of 100 cases, 20 have been detected, 80 have not been detected. So in case those ATR are also detected, then again it may have a material impact on financial statements. So loans to consultants, related parties, employees or government employees are made for unspecified services. So you take a contract and we find that some fees is being paid to a particular consultant as and when a particular contract is obtained. But from the documents, one cannot decipher as to what services the consultant is rendering. So the auditor has to go into deep and find out that is it in the nature of a payment of a bribe, or is it in the nature of a payment of something, facilitation fees to obtain the contract. Again, this is one important area. Purchasing at prices significantly above or below market price, especially in case of related party transactions. Unusual cash payments, bearer check payments. So why unusual cash? Why unusual bearer checks? Are these in nature of certain expenses which have been substantiated by false invoices? Again, this needs to be examined. So these are certain indicators of non-compliances. Payment without proper exchange control documentation. Payment for goods or services made other than to the country from which goods or services originate. Yeah, this at times this is viewed very seriously by RBI, that you have imported the goods from China but have made payment to Dubai. So whether those transactions are genuine, legitimate or not, again these are to be scrutinized. So withdrawal fraud. So this is all about non-compliances of laws and regulations. So if it is a material non-compliances which is not adequately reflected in financial statement, auditor may issue a qualified or a adverse opinion. There is a scope limitation. Auditor is unable to obtain evidence. Then the auditor may even resign from the audit after seeking legal advice. We have discussed about return reporting to the regulators, documentation. So this is all about SA 250. Let us discuss some cases here, one or two cases here also. So this is a particular case where, say, a pharmaceutical manufacturer uh, was faced regulatory action. He had a factory production facility which accounted for 60% of its output. It underwent inspection by US FDA, and violations were found by FDA in its manufacturing practices. And therefore, the regulator said from this plant, you cannot sell goods. And the plant remained closed. The company was in talks with the regulator to lift the restrictions. So, what are the issues here? That first, you are not able to sell the goods from the plant. Second, the inventory may not have been found to be in a proper condition, as you are uh, violating the manufacturing practices, and therefore it may remain unsellable. So you have inventory which may remain unsellable. There may be indication of going concern, because this is a plant which sells 60% of your output. Then there may be fines, penalties. So therefore, the auditor has to consider the application of all these on the financial statements. So first, the companies, as I said, non-compliance with manufacturing practices is direct financial implications. There may be inventory writes off. So auditor has to understand what is the severity of this and what are the remedial actions. He has to inquire whether inventory is sellable or does it to be need to be written off or downgraded. What are the potential fines, claims from the customers also? Maybe because since these goods were not conforming to the manufacturing practices, the goods earlier sold may also invite wrath from the customers. If there is an unsellable stock, write down to its market value. What are the points relating to potential fines and penalties which can be, you know, uh, levied by the regulator, plus a fact about the going concern assumption. Now the auditor has to understand everything. After taking into consideration, he may, and if certain accounting adjustments are required, he would require ask the management to make the accounting adjustments. If he is satisfied that no, this is a inquiry which may not crystallize into actual liability, maybe the company was not able to demonstrate it properly, again supported by legal advice, again supported by evidence, then perhaps it is a good case. Else, the auditor has to evaluate after taking into consideration everything, whether it is a case for qualified opinion, emphasis, and even a case of material uncertainty relating to going concern. So this is one case of cartelization. The CCI conducted an inquiry and imposed a penalty on a company for entity competitive practices. The company filed an appeal with the appellate tribunal and insists that penalty would not stand. Management did not recognize the provision as it was the view based on its legal counsel view that penalty would not be sustained. Now auditor has to assess whether the treatment is appropriate. As we said, this has a material impact. It is also an ethical dimension. If the company was indeed doing cartelization, colluding with others in jacking up prices, it is also a serious compliance and governance issue. So it may have a material impact by way of penalties. So auditor should gather about compliance with laws and regulations. Since this compliance has been non-compliance has been pointed out by a regulator, auditor cannot ignore this. Auditor standard advises auditor to discuss with management, seek legal advice to understand the likelihood of the penalty sticking. If information is insufficient, the auditor may consider uh, uh, revi- modifying his opinion. So, one again, as I said, crucial piece of information is legal assessment of PQR chances to appeal. So, these are the certain issues which the auditor needs to evaluate before taking a call as to how to go about this, whether it is a case of provision or merely a contingent liability or an emphasis of matter. Now, we take up this as another case where, uh, as we all know, in companies, you have section 196, 197, and schedule 5 relating to managerial remuneration. So it was a case where remuneration was linked to profit. The company incurred losses, but still remuneration was paid because under 197, the remuneration is linked to a percentage of profit. So the company was only complying 197, not schedule 5. So there was a loss, but then the managing director says since the he's the 51% shareholder, then approval is not an issue at the shareholder. They would seek post ratification or post facto approval. Now auditor find that it is a case of non-compliance. Straight away non-compliance. Financially, the company has made an excessive remuneration and claimed it as an expense. Now the question arises whether it should go late reported or auditor should ask the management to debit the amount of the excess remuneration paid as recoverable, because if it is not done, it would have an impact on the profits. So they may seek retroactive approval. If that is not feasible, then he has to recover the excess amount. So auditor has to evaluate all options, and only after evaluating it options, it would be in a position to whether to qualify, not qualify, whether to draw emphasis. So let us say management says, okay, we call an EGM and seek post facto approval. So then that is fine. Alternatively, management says, yes, excess has been paid. You have identified the potential non-compliance. We debit it and recover from the managing director immediately. So auditor may not here qualify, but may draw an emphasis of matter. So again, full disclosures, unless made, things may turn out to be difficult for the company. So in case, as I said, company does not take any corrective action, then the auditor would qualify that the company has paid excess managerial remuneration in excess of limit without approvals. Had the company obtained the requisite approval or recovered the amount, loss would have been lower by this amount. So this is a case of qualification. So we take up this last case where a company is subject to drug price control order, which puts a cap on supply of medicines. The company sold drugs at a price excess than that was mandated by DPCO, Drug Price Control Order, and the authorities sent a demand of 400 crore to the company for overcharging, which includes principal of overcharge, interest, and potential penalties. The company contests this demand, and based on some technical points, it says that 100 crore is a sufficient provision, and that is the best estimate of why what the company would have to pay. And further, I said that any additional penalty is unlikely and thus have not provided for penalties. Auditor has to assess SA 250. So 400 crore is the potential liability. The company wants to provide only 100 crores. Auditor has to understand how the management has arrived at 100 crore. Presumably, it is principal plus interest up to some date. If the government said 400 crore penalty, does it cover everything? If not, why only 100? Or auditor has to challenge. How have you come at a figure of 100 crore as against 400 crore? He should review the correspondence with the regulator and any legal opinions as to why 100 is sufficient. Management may say that penalty is not applicable due to a technicality. Again, that requires waiting. If no legal opinion, auditor should stress on a legal opinion again from a competent person. He has to also see the DPO provisions, the earlier orders also. Often they are strict and penalties can be imposed if overcharge is willful. If the law generally imposes penalties and many companies had to pay, calling it remote by the company, because many a times management is always positive and they will say, no, no, we'll try to get the penalty waived. But auditor says, based on past orders, based on past instances of non-compliances by similar other companies, the DPCO did not waive off the penalties. Therefore, what makes a good case for you not to record for the penalties? So, if evidence suggests that payment of at least principal and interest is probable and penalty is not certain, the provision might cover 100 crore might cover the likely outcome. But if there is a significant chance of penalty, even if it is not probable, it should be disclosed as a contingency. Auditor should consider whether disclosing the potential additional 300 crore could also mislead users. If there is a remote chance based on a technicality, then even disclosure of a 300 crore may, because often we think that look, there is a demand from a regulator, it is a contingent liability, whether rightly or wrongly. So auditor, if determines and discloses the 300 crore penalty as a contingent liability, it may also mislead the users. The audit should The auditor notes should mention that additional penalties could arise if the dispute is not resolved, but management believes it is not lying. So, what I mean to say, full, true adequate disclosures of the facts and circumstances, evaluation, what has happened in the past, what did the company do, has the company did earlier, what happened when the company did earlier also. So many a times the regulator is not very severe on the first instance of violation. May not be severe. I would not say will not be severe, but may not be severe on the first instance of violation. So everything has to be understood, and as I said, SA 230 250 go together. Everything has to be understood, documented, and then a call should be taken. So this is all about SA 250. I uh, stop here for 10 minutes in case you have any possible questions. Yeah.
Yes. Uh, Hello.
Yeah.
Sir, we have received a questions on SA 250s.
Yeah.
Whether we can, whether we have came across some, we find some unusual transactions related to money laundering. And in that case, we should inform with the regulator direct or first communicate with the management
Okay.
for any non-compliances.
Okay. So first, number one, uh, we have we have identified that there are possible violations of say PMLA. Let us say we should write to the management. First, important is we should the write to the management. We should not never straight away write to the regulators without seeking any response from the management. We write to TCW, audit committee, board, as the case may be, seek their appropriate responses. Once we are not satisfied with the responses, then we have to take a call as to how do we deal in the financial statements. If required, we seek legal advice. Now, our onus to report to the regulator arises only if the law so requires us to do. For example, as I said, in case of RBI says that any non-compliance of RBI Act and directions you report by way of an exception report to RBI. In case of fraud, central government says if fraud involvement is 1 crore or more, you report to the government in case you have detected the fraud, not the management. So again, you have to evaluate if there is a requirement of the regulator, then you have to act accordingly. But one should definitely first communicate your findings based on all audit evidence you have gathered, supported by legal advice if necessary, to TCWG, audit committee, or the board, as the case may be, and then do the next course of action.
Okay. Thank you, sir. And sir, if a new law is enacted after year end, but before signing the audit report, so should it be considered in our audit or not, sir?
Generally, laws are prospective and not retrospective unless it is made retrospective. Like we have seen, any penal laws are prospective. Generally, we find income tax makes retrospective amendment. To give you two situations, that we had one education cess, if you recall, which was claimed as a deductible business expenditure till I think it was 22 or 23. So whatever tax we paid, say 100 rupees was the tax, 15 was the surcharge, 115 over this 15 surcharge, we used to pay 5 rupees as cess. So 120. Out of this 120, 5 rupees we used to claim as expenditure on account of education cess, because the way 40 AIA was worded, it was presumed that disallowance is only on account of income tax and surcharge and not cess. So many courts and tribunals took a favorable view, and all along, many companies claimed this education cess based on income tax as a deductible expenditure. Now, the finance ministry, the budget in I think 22 or 23, they made a retrospective amendment that this was never the intention of the legislature. And what you do, you uh, whatever cess you have claimed earlier, you pay tax on that. Else, in case we reopen, we will subject you to penalty. So companies again, so this was a case. Say, let us say this had happened, and this was before the signing of a report, and this retrospective amendment went on for last 2 3 years. So we have to we have to calculate taxes and provide in the financial statement. One. Second, but you said after 31st March, a particular law was enacted, whether we have to consider. Therefore, I presume, assuming the law to be prospective, auditor is not required to report on the compliance of this law and regulation. This is how I would answer your case. Yeah,
Hello.
yeah,
So it is the last question that
yeah.
is NOCLAR applicable to internal audit also?
Yes, yes. You see, internal audit, what is important in internal audit that the section 138, that the coverage scope has to be decided by the management in due consultation. Now, if the management does not cover within your scope statutory non-compliances, then perhaps you would not report. Because again, it is a contract between the management and the internal auditor. But if the management covers within the scope, ideally every management would cover that in case there are laws, regulations, say payment of taxes, GST, TDS, and other things also, whether the company is regular in payment of all those taxes, whether there are non-compliances, you have to report. So all depends upon the terms of reference between the management and the internal audit. There is no explicit mention in the law of this.
Okay. So thank you, sir, for sharing the valuable insights on audit documentation and NOCLAR, sir.
Thank
Uh,
you.
in today's session, sir, we have joined by more than 1,000 members.
Oh, great.
And so we are very thankful to all the participants for their active participations. So
Thank you.
thank you, sir.
Thank you.